5 years ago this week, Lehman Brothers collapsed. Now, the question you should ask yourself is Wall Street any safer since that collapse? And we have 3 different opinions for you. So the Wall Street Journal, citing some, reformations at Morgan Stanley as a shining example that, Wall Street firms are truly cleaning up their act. Indeed, there's more than this is at Morgan Stanley, there's more than 3,000 different limits that restrict such things as how much capital traders can put on a risk, and on and on and on. There's about 50 full-time government regulators now stationed at Morgan Stanley that make sure that they're doing the right thing, more than before 2008. And they're regulating how brokers do deals, and most deals over 10 million now require a green light from a risk committee. Okay, so the Wall Street Journal says that because of what Morgan Stanley's doing in their reforms, Wall Street is indeed safer. Well, down the street from Morgan Stanley is Bloomberg. And Bloomberg says maybe. So what Bloomberg says is that government regulators plan to wind down the big banks in case of emergency. But what would happen in a situation where all the big banks were to sort of fall at the same time or implode simultaneously? Regulators aren't sure their plans to keep bank derivative trading partners and lenders from pulling out collateral in a run will work, according to many people. So this whole idea that if there's a simultaneous collapse, that people would just pull their money immediately and the whole market will sort of go in shambles, and there's no way to stop that. So maybe we're safer because there's more regulators, but maybe we're not safer because people with equity can pull their money out at any particular time and collapse the whole market. That's what they say. And Credit Suisse says not really, not at all. They say, however, Credit Suisse, after 23 years, warns not to confuse a sounder bank with a safer financial system. And I love this, so stay with me and I'll bless you. I'm going to read it exactly how they say it, and stay with me and we'll talk about it, right? Some amounts of risk have gone away because some activities are not being undertaken anymore. But also a fair amount of risk have been transferred to other parts of the system. Areas like shadow banking, insurance companies, and pension funds and retail investors. So they're saying that yes, we've clamped down on derivative trading, and yes, we've clamped down on this sort of packaging mortgages, but the darkness has now shifted. So now, because regulators are now looking into, derivative markets, they have a light on it, or the sun is on it, that's in the light. But what's happening in the dark is still happening in the dark, and there's been a shift. And this shift means that our system really isn't safe, and if any of those markets collapse, we'll be in trouble. So either way, there seems to be 3 different opinions on this. Now, I'm not going to take one, but I sort of tend to agree with Credit Suisse a little bit that, think about it. So they're not packaging mortgages now, but now they're packaging student loans. That's not much better at all. It's almost even worse. So America, the proof is in the pudding. I'm crossing my fingers we don't have another bank collapse, but hey, who knows?